Hey there, quick question. Have you ever noticed how your bank is always so happy to take your money, but extremely calm about giving it back? Like, suspiciously calm. You walk in, deposit your paycheck, and the bank is like, thank you, we'll take great care of this. But what does that actually mean? Because your money doesn't just sit there. It goes on a little adventure. Let's meet Alice. Alice gets paid on Friday. She's responsible. She puts her money in the bank. Not under a mattress, not in a shoebox. A bank. Because banks are safe. So Alice opens her banking app, sees her balance, and goes on with her life. What Alice doesn't see is what happens behind the scenes. Because the moment Alice deposits her money, it quietly stops being her money. Not emotionally, legally. It becomes the bank's money. And the bank makes money by making sure Alice's money is never just sitting around doing nothing. Let me introduce Bob. Bob runs a bank. Bob loves deposits. He smiles every time Alice deposits her paycheck. Not because Bob is kind, but because deposits are raw material. Like flour for a bakery. Bob doesn't keep flour on a shelf forever. He turns it into bread. So what does Bob turn Alice's money into? Loans. Mortgages. Car loans. Business loans. Credit cards. Bob takes Alice's $1,000 and lends it to Charlie. Charlie buys a car. Charlie pays interest. Alice, she gets maybe 0. 5%. Bob gets the difference. This is the first magic trick. The interest gap. Banks pay you a little and charge borrowers a lot more. That difference is profit. But here's where it gets weird. Bob doesn't wait for Alice's $1,000 to be lent once. He lends multiples of it. How? Because banks don't keep all deposits in cash. They keep a fraction. A reserve. The rest gets lent out. So Alice's $1,000 might help support $5,000, $10,000, or more in loans. Not physically, digitally. This is why banks love trust. As long as people don't all show up asking for cash at the same time, the system works. Bob knows most people won't. They trust the app. So Bob can safely keep only a slice of cash and put the rest to work. Now let's pause. Alice thinks her money is in the bank. In reality, it's scattered across the economy. Working. Earning. Not for her. For Bob. Now, Alice might say, wait, if my money's being used, why don't I get more of the profit? Great question. And the answer is because Alice values safety. She wants her money available anytime. Instant access. No risk. Bob provides that service. And charges for it quietly by keeping most of the upside. Now let's talk about fees. Because interest isn't the only way banks make money. Fees are the sneakiest part. Account maintenance fees, overdraft fees, ATM fees, foreign transaction fees, tiny amounts. But across millions of people, huge. Alice overdrafts once. Bob shrugs and charges $35. That fee costs Bob almost nothing to process. But it adds up. Now let's talk about credit cards. This is Bob's favorite toy. Alice uses a credit card. She buys something today and pays later. Bob charges the store a small fee. Bob charges Alice interest if she doesn't pay in full. Bob wins either way. If Alice pays on time, Bob earns from merchants. If Alice pays late, Bob earns from Alice. This is called optional pain. Alice chooses convenience. Bob prices the risk. Now here's the part that feels unfair. Alice's money is safe. Mostly. But Bob takes risks with it. Calculated risks. Diversified risks. If a borrower defaults, Bob doesn't panic. He expected some defaults. They're priced in. So Bob spreads Alice's money across thousands of loans. Some fail. Most pay. The average works. Now Alice asks something dangerous. What if everyone wants their money back? That's called a bank run. And Bob hates that question. Because the system depends on confidence. As long as people trust banks, banks can keep lending. Once trust breaks, everything freezes. This is why governments step in. Deposit insurance. Emergency lending. Backstops. Not to protect Bob's feelings, but because the entire economy runs through banks. They're the pipes. If the pipes freeze, nothing flows. Now let's talk about something subtle. Banks don't just lend money. They decide who gets money, which businesses grow, which ideas get funded, which neighborhoods develop. This gives banks enormous power, not political power, economic power. Bob doesn't vote on laws, but Bob influences outcomes by saying yes or no. Now, Alice might be thinking, okay, banks make money using my money. But is that bad? Not necessarily. Banks turn idle money into productive activity. That's useful, but it comes with trade-offs. The system rewards those who already have access. Good credit, stable income, assets. If Alice has those, money is cheap. If she doesn't, money is expensive. Same bank, different Alice. Now here's the part most people miss. Banks don't make money by being right all the time. They make money by managing averages. They don't care if one loan fails. They care if the portfolio works. So when Alice feels personally judged by a bank, it's not personal. It's statistical, cold, efficient. Now let's zoom out. Alice's money is sitting in the bank, but it's not resting. It's being multiplied, sliced, packaged, helping create credit. Credit creates spending. Spending creates growth. Growth creates more deposits. The loop continues. So banks make money using your money by turning trust into leverage. They borrow from you cheaply and lend to others expensively. They manage risk across millions of people. They charge fees for convenience. They profit from time. And Alice? Alice gets safety, liquidity, and simplicity. Which feels fair until she realizes just how hard her money is working and how little of that work comes back to her. And that's when the next question naturally appears. If banks can do this with her money, what would happen if she understood the rules well enough to play the game a little differently? Because once Alice sees what's happening, she stops thinking of the bank as a vault. She starts seeing it as a factory that runs on other people's money, including hers. And that changes how she looks at everything. Alice realizes the bank isn't doing anything evil. It's doing something very specific. It's transforming short-term trust into long-term profit. Alice gives the bank money she might need tomorrow. The bank lends it out for years. That mismatch in time is where the magic and the risk lives. Now here's something most people never hear. Banks don't want you to keep a lot of money with them. They want just enough deposits to lend. Not so much that they have to pay you meaningful interest. That's why savings rates are usually low. If banks paid you a lot, their raw material would be expensive. So they gently discourage hoarding. Tiny interest, small perk, lots of convenience. And Alice accepts it because convenience feels good. Now let's talk about risk again. Because Alice assumes the bank is taking all the risk. Not exactly. If the bank messes up badly, the system steps in. Governments insure deposits. Central banks lend in emergencies. Why? Because letting banks fail freely would wipe out ordinary people. So banks operate with an invisible safety net. Not unlimited, but real. That doesn't mean banks are reckless. It means they can afford to be systematically confident. They know panic will be stopped before it spreads too far. This is why banking is boring, until it isn't. Now let's flip perspectives. From Bob's chair, Alice's deposit is a liability. Yes, liability. The bank owes Alice that money. Loans are assets. So Bob's job is to turn liabilities into assets as efficiently as possible. This is why banks push lending. Not because they love borrowers, because loans are how banks earn. Now here's the part that really surprises Alice. When Bob issues a loan, he doesn't hand over existing money. He creates new money, digitally. The loan appears as a deposit in someone else's account. Money expands. So banks don't just move money. They create it, within limits, regulated limits. But still, creation. This is why banks sit at the center of the economy. They decide how much credit exists and where it flows. Which means they indirectly influence housing prices, business growth, consumer spending, all by deciding who gets a yes and who gets a no. Now Alice thinks back to her credit application. The forms, the checks, the score. It felt personal, but now she sees it differently. The bank wasn't judging her character. It was pricing risk. How likely is Alice to repay? How much can we charge? How much capital must we hold? It's math wearing a friendly face. Now let's talk about why banks love predictable people. Stable job, regular income, boring behavior. Predictability lowers risk. Lower risk means cheaper loans, which means more borrowing, which means more profit. So banks quietly reward stability and quietly punish chaos. Now here's where Alice connects the dots. People who already have money get cheaper access to more money. People without it pay more to borrow. So money attracts money. Not because banks are cruel, because risk compounds. This is how inequality sneaks in without anyone announcing it. Now Alice asks the final uncomfortable question. Do banks need me? Yes, but not individually. Collectively, Alice is one data point, one deposit, one risk profile. The bank doesn't care about Alice. It cares about a million Alices. And that's what makes the system feel impersonal. Now let's zoom out one last time. Banks make money using your money by doing four main things. They borrow from you cheaply, they lend to others at higher rates, they multiply deposits into credit, they charge fees for convenience and risk. In return, they give you safety, liquidity, stability, a place to park value. It's a trade, a quiet one. Now here's the real takeaway Alice lands on. The bank is not her enemy, but it's not her financial coach either. It's a business. And businesses optimize for themselves. So understanding how banks work doesn't mean you stop using them. It means you stop being surprised. You understand why interest is low, why loans cost more, why fees exist, why credit matters so much. And once you understand that, you can make better choices. Not emotional ones, strategic ones. You stop asking, why won't the bank help me, and start asking, how does the bank make money here? Because the answer to that question tells you everything. So, in conclusion, banks make money by taking the cash you deposit, paying you very little for it, and lending it out at higher rates while managing risk across millions of people. They turn trust into leverage, time into profit, and convenience into fees, all while keeping the system stable enough that you rarely notice what's happening. Once you understand that banks aren't vaults, but businesses built around credit creation, the whole system suddenly makes sense. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.